Hey everyone, welcome back to the show. My name is Mike, this is my whiteboard, and today we're going to talk about earnings strategies. So we're going to look at 3 credit strategies for earnings. Some viewer actually submitted this email and asked me to cover these 3 specific strategies, so that's exactly what we're going to do today. So we're going to be looking at the Iron Condor, we're going to compare it to the Chicken Iron Condor, and also we're going to look at the Jade Lizard, and we're going to look at different scenarios and see why we might use one over the other. So let's dive right into it, and we'll look at the first scenario, and we're going to look at each of these 3, and we're going to discuss why we might look at each of these. So the very first one is going to be an Iron Condor, and for me personally, I would say if I'm going to deploy a regular Iron Condor in earnings, it's probably if I'm a beginner or if I want to see what would happen with an earnings announcement, maybe how the option prices are affected after the earnings announcement. As we know, with earnings, there is an implied volatility spike usually, and normally after the earnings announcement, when the unknown becomes known, the volatility tends to contract. So we call that a vol crush. So the option prices are actually going to be reflective of that implied volatility. So again, implied volatility is just looking at the option prices. So if implied volatility is high, that means that the option prices are higher. So if I can sell premium up here, and then after the earnings announcement, now that everyone knows what had happened, the volatility is usually going to decrease, which can result in profit if I'm selling premium up here and buying it back down here. So for an Iron Condor, I'm usually going to look at maybe a beginner strategy, and you'll see why on the next slide. But let's take a look at the Chicken Iron Condor. So the Chicken Iron Condor is something I'm going to do for maybe larger underlyings. It usually works best for large underlyings, and it gives me some protection in a certain way that we're going to cover. And lastly, we're going to look at the Jade Lizard. And for me, this is an opportunity to get long with the Jade Lizard. There is a difference between the Jade Lizard and these 2 strategies up here, which we'll cover on the last slide. But first, let's dig deep into the Iron Condor on the next slide here, and we'll talk about basically the max profit, max loss, break-even point, and we'll give you a good gauge of earnings and what is expected of earnings. So yesterday we talked about expected move during earnings. So we talked about calculating the expected move in a general setting, but also looking at the market maker move on Thinkorswim and also in the Doe platform, and using that value to determine what the market is expecting, what sort of move the market is expecting out of this underlying. So let's say there is an expected earnings move of 10 points, so plus or minus 10 points. And if you have it enabled on the Doe trade page, which is very easy to do, you can just pull up the trade page on Doe, click on settings in the lower left, and then click on the bullet point that allows you to enable that expected move for earnings. And you'll see an orange bar appear here. So basically, if I know that I have a 10-point earnings expected move, you're going to see the orange bar add 10 points to the upside and also add 10 points to the downside. So in this example, we're looking at a high IV environment where we've got an earnings expected move of 10 points with the underlying trading at 75. So let's say I can deploy a regular Iron Condor where I'm looking to collect 1/3 the width of the spread, and I've got a 3-point wide spread here. So let's say I'm able to actually completely cover the expected move and more. So in this example, the expected move would bring us to 85 on the upside, which is just adding 10 points to 75. And then it would bring us down to 65 on the downside. So let's say I can throw on a 90-93 call spread, sell that, and then sell the 60-57 put spread for a total credit of $1 even. So I'm collecting 1/3 the width of the spread. Since both of these spreads are 3 points wide, my max loss is going to be $200 because if I'm collecting $100, even if the stock price goes all the way through my call spread or all the way through my put spread, I would have to buy one of those spreads back for $3 at expiration. Again, only one side of these can be a loser. A stock can't go through the put side and the call side at the same time. So I would only have to close out one of those spreads for a full loser if I did have to do that. But since I collected $1 in profit, I can offset that max loss, which brings it down to $2 as opposed to $3. Now, if we look at our break-evens, since we're collecting premium, and as for all premium collecting strategies, our break-evens are going to be benefited. So if I'm collecting $1, all I need to do to determine my break-even is add $1 to the upside here, so from 90 to 91, and subtract $1 from the downside, so go from 60 to 59. So my break-evens here are going to be 59.00 and 91.00. If I have to buy back the short call at 91, and let's say I have to buy back the put at 59, I'm going to have a 1 point of intrinsic value there. So if I collected a profit or a premium of $1 and I have to buy it back for $1 at expiration, that's going to give me that break-even price. So that's how I'm determining that break-even value. So for this trade specifically, it's going to have a high probability of success. As you can see, we're covering the expected move and more. So even if the stock price does go up to 85 or down to 65, we still would have options that are out of the money. And usually when we're deploying earning strategies, we're looking at using the closest expiring options that contain that earnings announcement. So if there was an earnings announcement today, I would use the expiry for tomorrow. So I would only have 1 day to go on that expiration. And that is what's going to give us the benefit of executing this strategy, because even if the stock price does go up 10 points, I would still be out of the money on the call side, and my put side would be way out of the money as well. So I would usually be able to close that for a pretty nice winner there. So for iron condors, I would say that I would be looking at maybe a beginning trade. Maybe if I've never traded earnings before, I want to probably stay with defined risk. But maybe if I don't have an assumption as to where the stock's going to go, then I would maybe deploy an iron condor. And that's why I've marked it for beginner. Now let's take a look at the next slide, and we'll look at the chicken iron condor. So the chicken iron condor is a really interesting trade and one of my favorites for earnings overall. So a chicken iron condor is basically setting up an iron condor where we're not collecting 1/3 the width of the strikes. We're trying to collect 40 to 50% of the width of the strikes. So let's say we've got a strategy set up here in a large underlying. So normally when implied volatility is higher, this strategy usually works better for larger underlyings because we're able to collect more of that width of the spread easier. So in this example, you'll see that I've actually moved my short strikes into the expected move. So let's say the expected move is 50 points here. So we've got an underlying trading at 500, and I've got a 545 short call and a 455 short put. And then 10 points out, I've purchased the 555 call, and 10 points to the downside, I've purchased the 445 put. So I've got a 10-point wide chicken iron condor with the short options a little bit inside that expected move, as you see here. So normally we can collect about 50% of the width of the spread in a situation like this. Sometimes we are lucky enough to bring that call just outside or just at the expected move, which is the optimal situation in this example, but I wanted to highlight that we can still do this because of the fact that it's going to give me my break even right at that expected move. So if my max profit, let's say I collected a $5 credit for this 10-point wide chicken iron condor. I'm collecting 50% of the width of the spread, so it's basically aligns with the chicken iron condor mindset. So my max profit is $5 or $500, and that's if the stock price stays within my short strikes at expiration. And my max loss is $500 as well. So the big takeaway for this strategy is that with larger underlying specifically, we normally would see those massive moves. We're not really going to see a massive move in an underlying that's maybe trading for $50 or $60. Usually the larger, more magnified moves are the ones we see in those $500, $600, $700 underlyings. So what this does is it gives us blowout protection. So when I say blowout protection, I'm only 45 points away from the stock price, and the expected move is 50 points. So if the stock price ends up going up 100 points, it gives me more blowout protection than if I were to have traded a regular iron condor. Sure, my regular iron condor, I can probably get further away, but I would be collecting less, and therefore my max loss would be higher. So in this same example, if I moved these strikes out for a regular iron condor and only collected $3, which would be a third of the width of the spread, I would be at a max loss of $700 if I was to get blown out on one side. So the break-evens, as you can see, since I'm collecting $5, you just add the $5 to the call side up here from 545. That brings us to 550. And on the downside, you would just subtract that premium from the put. So the 455 put, subtract $5, that brings you to the 450 value. So another interesting thing about this strategy is it not only gives us blowout protection, but if we're correct and this stock price doesn't move, or it just moves a little bit, we're going to get paid, because we're going to be collecting a lot more premium. We're collecting about half the width of the spread in this example. So if the stock price doesn't move and implied volatility deflates rapidly, we're going to see a lot of that profit realized the very next day or maybe a couple days after. So these are the two reasons why I like this strategy the best. Number one, it gives me blowout protection if I'm wrong and lets me lose less than if I were to have deployed a regular iron condor. And if I'm correct and the stock price stays within the expected range or expected move of that earnings announcement, then I'm going to get paid more than if I were to have just deployed a regular iron condor. So let's look at the last example, which is the Jade Lizard here. So we've got a Jade Lizard, which again is just selling a put and selling a call spread against that. So let's say we've got an underlying trading at 70 and an expected move of about 10% of that underlying. So 7 points to the upside or downside. And let's say I collected a $5 credit, which meets the criteria for a Jade Lizard, since in this example, my call spread is 1 point wide. So with Jade Lizards, we always want to collect more than the width of our call spread to ensure that we don't have risk to the upside. So if the stock price ends up blowing through this call spread here, I would still be at a profit of 5 cents, because even though I would have to buy back this call spread for $1, I collected a $5 originally. So I would be able to offset that $1 loss by my dollar credit here and then have 5 cents left over. But the goal is for the stock price to stay in this range. So if that happens, my max profit would be 105, which is just the credit that I received. And this is where the difference comes into play. Since I've got a Jade Lizard, I don't have defined risk on the downside. So for me, this would be an opportunity to get long if I'm wrong. So instead of purchasing the stock outright, I would be at a break even of 60.95. So really all I'm doing there is just taking the 62 strike, subtracting my max profit of $5, which brings me to the 60.95 break even, which is $6,095. If the stock price goes to zero, that would be my max loss. But when we compare getting long the stock at 70, which would give me a cost basis of $7,000, and giving me a cost basis of 60.95 if I were to be assigned, because really if the stock price goes down to 60 or 59, my cost basis is at 60.95 and I would just be long shares down there. So I would have almost 10 points of extra value that I could gain as opposed to just buying the shares outright. So for a Jade Lizard, this would be an opportunity for me to get long if I'm wrong. So let's wrap all these up with some takeaways here for you. So the first takeaway is that earnings can provide high IV environments. Sometimes they don't, sometimes they do, sometimes they really, really do. And in a lot of situations, we'll see a high implied volatility, and then right after the earnings announcement, we'll see that volatility collapse. So that's why you always see, or mostly always see, us deploying the credit strategies where we're collecting premium around earnings. Secondly, credit strategies take advantage of this. So when you compare a credit strategy to a debit strategy, if I'm buying an option and the implied volatility decreases, that's going to hurt my position. So more often than not, almost always you'll see us deploying credit strategies, whether they're defined risk or naked premium. And lastly, there are different strategies for different scenarios. So as you saw in these three examples, we've got strategies for getting long if we want to get long the stock, we've got strategies for larger underlyings, and we've got strategies for people that are just getting their feet wet with earnings experiences. So really it's determining what you want to do, what you're comfortable with, whether you like defined risk or undefined risk, and going from there. So thanks for tuning in. This has been the 3 credit strategies for earnings from my point of view. If you've got any questions at all, shoot me an email at support@dough.com or support@tastytrade.com, or you can tweet me at DoughTraderMike. But stay tuned. Next, we've got Jim Schultz from Theory to Practice.